Welcome to the Privcap Podcast, where leading professionals in private equity and institutional real estate share best practices, investment ideas, and everything you need to succeed in the private capital industry. Today, Privcap's David Snow interviews Andrea Auerbach, Global Head of Private Investments for Cambridge Associates. They discuss the current state of the private equity market, including the surge in distributions back to LPs, and the performance of the largest private equity funds, which is beginning to mirror the average performance of the stock market.
The private equity deal market has been relatively robust, perhaps not as robust as in the sort of 2007-2008 period, but it's been robust, and during that time, a ton of private equity capital has been raised, adding to the so-called overhang or the dry powder buildup. In your view, have GPs been exiting at a pace that is getting capital back to the LPs fast enough?
Interesting question. So if we look at the history of distributions coming back to LPs. So obviously at Cambridge Associates, we love tracking lots of things, and we were the first to define and measure the overhang, and I'm just thrilled that we're all now closely paying attention to the amount of dry powder waiting to get deployed. In terms of distributions, distributions have been peaking. They peaked, according to our information, in 2014 for private equity and venture capital globally at around $260 billion. But we've had $200 billion distribution years from 2013 through 2017, 2018. So we have had feast. We have absolutely been in a feast distribution situation for the last 6 years. And if you think about 7 years of feast, 7 years of famine, one of the things that we're concerned about is because of this unprecedented level of distributions, we are actually expecting a return to normal. A little longer explanation for this, but if you think about fundraising and investment activity in private equity, so fundraising in private equity has continued to go up and to the right in the last 5 or 6 years, right? And distributions have also been very significant. But if you think about the typical cycle of capital called versus capital distributed, our industry, if I go all the way back to 1991, from 1991 to 2010, we've had more years where more capital has been called down from the industry than returned. And the reason for that, David, is because private investing is a growth industry. More and more funds are constantly raised that are larger than the funds before. And when the larger fund capital gets called down, the industry goes net negative, goes net called, if that makes sense. And so what we're anticipating is that the distributions have been great, and I believe with all the record fundraising years we've been having, as that capital gets called down, we will once again go into a net negative where more capital is being called than being given back. Now, the one caveat I'm going to put on everything I just said is that dividend recaps are alive and well. As long as interest rates are staying low and the capital leveraged loan volume is flowing, then most private equity GPs have a great way to hit the buzzer on their IRR clock and return capital back to LPs in that capacity. So that's sort of the one X factor I will put on distributions going forward.
And of course, what's happening with all this capital that's getting returned to LPs, this feast as you call it, they're turning right back around and committing it to new, oftentimes larger private equity funds, right?
Yes, the Cuisinart of capital activity within private investing. There's a lot of capital coming back in to our private investment arena. And on a global basis, we were tracking 2018 as the highest year ever at $454 billion for 2018, right? Now, what's interesting to me as I look at that capital, and something we've been thinking about quite a bit, is the rise or the continued shadow that mega funds tend to cast over the entire market. And when we look at mega funds, and I'll define them as funds with $10 billion or more in commitments, mega funds comprise they comprise a third of the overhang, right? And they comprise a third of invested capital. And this is information that we have as Cambridge Associates through all the hard work that we do scouring the market and gathering information. And so a lot of that capital is going to the mega fund category, funds raising more than $10 billion, and they cast a very long shadow over the market. However, as I say that, overhang and capital continues to flow to emerging managers who are starting their journey, and that's obviously a fairly interesting and dynamic space as well.
Maybe final question for you, and that has to do with what these mega funds and private equity firms in general are going to do with all that capital. Is there an influence from the relative dearth of IPOs? I mean, there have been some high-profile IPOs, but in general, fewer successful companies are interested in going public, and they're more likely to be interested in staying private longer and therefore maybe find a home in some of these very large funds and fund-like entities like SoftBank. Do you see a connection there?
Yes, we do. In fact, one of the observations that we have is that as mega funds continue to raise more and more capital, $25 billion, probably 30 and 40 billion sized funds SoftBank obviously is way out there, sort of lapped the field with their fund size. But I do believe larger funds obviously are in our future. And one of the things we've been thinking about is larger funds need larger companies. And with the shrinking at least U.S. public equity stock market, the number of publicly traded companies has halved over the last 20 years. A lot of companies currently claim to not have an interest in going public, and so these very, very large pools of capital can provide homes for these very, very large companies. I think the challenge, if you look at the returns of these mega funds, is that they do seem to indicate as a group, an emerging public proxy. And in fact, analysis that we've done shows that on a 3, 5, 10, and 12 and 3/4 year basis, which is really when you started having enough mega funds to sort of put a yardstick and really see the kind of performance, is that the performance of this cohort is neck and neck with public market returns. And then when you look at the correlations, David, what you see is that the correlations of these very large funds of $10 billion or more are very highly correlated with the public markets. And I'm going to contrast that with the really small funds, funds of less than $1 billion, funds of less than $500 million, their correlation is half that of the mega fund cohort. So I think we're entering into an interesting time in private investments, as we always are. But I do believe these mega funds, as they continue to increase their capital, are going to start to, and already are, according to the information that we have, really start to provide that public proxy exposure. So the good news is these mega funds will provide you with exposure you can't get in the public markets, and that is a differentiated source of return. That's a positive. The concern of what does that cost? What am I willing to pay for that return stream, to go back to our earlier conversation, is a very interesting question. And then is a public market proxy sufficient given the dispersion of returns I could get access to in lower registers of the market? So lots of interesting questions right now and a lot to think about.
So are you saying that there's a chance that over the next 10 years, the largest private equity firms perform about neck to neck with the S&P 500 or some other public index like that?
Well, I mean, according to the historical information we've been looking at, they kind of already are. David, that's not to say, look, with every cycle that we've encountered in private investments, and there've been several, right? 1990, 91, it can continue and go through the peaks and valleys of private investing. As new fund sizes, as new fund high watermarks appear, several managers always manage to punch through the return ceiling that we thought they were going to be stuck under and deliver old school private equity returns, right? So I'm certainly not, I'm concerned about the cohort as a whole, but as you know and I know, investors don't invest in the market per se. They make very specific manager selections. And so we do believe that certain of these rising mega funds will continue to deliver on their stated return expectations. Overall, there's some interesting elements emerging that are worth considering.
Right.
Yeah.
There is no mega fund index. You can't buy that. You have to select specific managers within that cohort.
I mean, that's how, on the private investment side, that is exactly how you would do it. Obviously, some of these are publicly traded, and so it is,
Right.
you can't access in certain situations, their public equity. But on the private side, you are typically very specifically selecting certain of these funds for investment for your portfolio. And so, don't expect your return experience will be different from the cohort that I've been quoting.
Well, thank you so much, Andrea Auerbach from Cambridge Associates. It's always a pleasure to speak with you.
It's great to catch up with you too, David. Thanks.
Like what you hear on the Privcap podcast? Visit privcap.com for more thought leadership interviews, articles, reports, webinars, and more.